Everyone. Thanks for joining us. We are Practical Farmers of Iowa, and we're coming here tonight to broadcast a Farminar, another live winter Farminar, coming to you from Nevada, Iowa, and Jefferson, Iowa. And I see folks are from all over the Midwest, including into Texas and Missouri. Great to see you all here tonight, and thanks for joining us for this important topic on tax preparation for farmers. We are here because 42% of Iowa farmers say they will retire in the next 5 years. It's a really unprecedented time for land ownership change, for the next generation to come up with the challenges, to meet the challenges of the future. And we at Practical Farmers of Iowa, with our member network, we want to be a part of the success of the next generation of farmers, and we feel that we can do that through a bunch of different ways, mostly sharing our network and knowledge with each other through a variety of different ways, including these online seminars. This is the first of our Winter Farminar series. We've done this for about 3 years now and have 46 Farminars under our belts. And we're really glad to have you with us again. I see a lot of friendly faces from the fall seminar and, of course, from previous years. We're going to start the series with tax preparation. It's that time of year, and we're excited to share with you a host of other topics throughout the winter, from vegetable farms to row crop farms, livestock farms, poultry, and definitely business planning components as well. All important for ensuring the success of the next generation. We've done, as I said, 46 now Farminars. This is our 46th Farminar, and we have a big focus on planning in all of our events. And here you can see on your screen one of the speakers for tonight, Jerry Peckham, has a good history of helping beginning farmers throughout his experience and sharing that with others. And he's doing that again tonight with this Farminar on taxes. The game plan is that we will have brief introductions, my brief introduction here, and then following me, Jerry Peckham will introduce himself, and Leo Brooker, his CPA, will introduce himself and kind of set the stage for where they're coming from and their experiences. Then we'll have a great discussion on tax preparation for farmers, where you can include your questions from the chat box and get your questions answered, so we can all learn together some more key pieces of information to be successful in farming. And I'm sure our CPA is also excited to share some wisdom too with you all tonight. So be sure to bring your questions into the chat box. We are an open, supportive, and diverse organization, Practical Farmers of Iowa. We advance profitable, ecologically sound, and community-enhancing approaches to agriculture. We've been around since the 80s, and we're in our 27th year. And a really great opportunity for beginning farmers, as we have over 550 in our network. We want you to succeed. We want you to join our network, where you can share priceless knowledge and gain wisdom from beginning farmers and experienced farmers alike. Membership is an annual membership fee of just $45 for the whole farm, $35 for individuals, or organizations can even join for $85 per year. We want you to attend our annual conference if you're in central Iowa here, January 12th through the 14th. We have 3 great days of sessions, speakers, events, learning from beginning farmers and experienced farmers. And we want to call out a couple events for beginning farmers specifically that you might be interested in. Our Friday night mixer, 5 to 6 p.m. in the first floor lobby of the Sheeman building. And we also want to buy you dinner at a gourmet pizza restaurant after the conference with John Jaff from Connecticut joining us from Farm Credit Services, who does a lot of work with beginning farmers financing out east and wants to share and hear some experiences in the Midwest to gain to his or to share his knowledge with you. So let us know if you want to attend that free pizza with John Jaff on Saturday night following the annual conference. We at PFI believe in ideas and sharing them widely. You see our beginners make great friends, fast friends. We strategize together. And we are committed to sharing our knowledge with others. My screen is not advancing, and I'm wondering if anybody else is having problems out there.
Well, it is advancing here.
Okay, good. I will just advance it to the end, and there we go. So let's begin with Jerry Peckham, and then Leo Brooker, his CPA, and let's have some great discussions on tax preparation. Jerry, I'll bring up your slides so you can begin in a few moments.
Good evening. I'm Jerry Peckham. I farm in the Raccoon River watershed south of Jefferson, Iowa. My son Tom farms with me, and I live on the farm which has both good cropland and pasture timber. I started using Leo Brooker, who is a certified public accountant, for tax advice, income tax advice, at the time I started farming. And Leo has been a very competent tax advisor for me. I started farming as a sole proprietor and managing my taxes on a cash record basis. This has been advantageous for me from a tax management standpoint and from growing my business. My son farms also as a sole proprietor, even though we share equipment and labor. I believe in separate operations, so if something happens to me, Tom would know what is his, and allows us to keep our debt obligations completely separate. Also, in many cases, it is easier to obtain credit as a sole proprietor. At some point, I may turn to a corporation for limiting my liability and for tax management. Our records started out simple, but have gotten ever more complicated. I started with handwritten ledgers, bought accounting software, and eventually hired bookkeeping services. At first, bookkeeping was simple and the handwritten ledger was fine. I think it's still fine if you have a very simple operation and you're just starting out. At first, accounting software was complicated and burdensome, so eventually I went to simpler software. As I became busier in farming and life, it became a greater burden to keep records. My first attempt to engage a bookkeeper did not work out because the firm hired someone who was completely unfamiliar with farming and could not get expenses or income correctly coded without a lot of help. Then I continued to keep my own books reluctantly until I engaged Leo Brooker to provide that service. I'm very happy with this arrangement. Timely records are so important. Records are beneficial for tax planning, but also crop sales timing and financial analysis. I wish I had engaged Leo for bookkeeping services a lot sooner. One thing I wanted to talk a little bit about was cash versus accrual tax accounting. In farming, we may choose to keep our tax records on the cash basis or on the accrual basis. For a financial advantage, I keep cash records for income tax purposes, but I learn, and you should learn, to convert those records to accrual for business analysis, for budgeting, for cost accounting, for long-term planning. If you do not want to learn to understand accounting for business analysis, then it is essential to hire that service also. Adjustments to a cash record keeping system are inventory, accounts payable, accounts receivable, and actual depreciation of capital property. Keeping a good inventory of your production and of the supplies you have on hand, such as fuel, parts, fertilizer, etc., will allow you to make a business analysis based on a production period that begins and ends at the appropriate time. A growing season, a reproduction season, monthly or annually, are all seasons or periods that you may want to keep books for. I like to know on a monthly basis where my farm stands. It's very important to meet with a competent tax advisor well before your fiscal year ends to review how to legally minimize your tax burden. That could save thousands of dollars. As an agricultural lender over many years, I had many customers that had a very poor understanding of tax management. And overpaying taxes can really reduce your ability to grow your business. Every dollar you save in tax, in your tax burden, is dollars that you can put towards buying land or buying capital. And it's important that we all pay some taxes, but there's no reason for anyone to pay more than what they're legally required to do. And something I really want to warn you about and have you think about is that you must understand is that the tax code greatly encourages the purchase of capital equipment by allowing a full deduction for the entire cost of a capital item in the first year of the purchase. Allowing that deduction is quite an advantage for tax management, as long as the capital item provides a good return. But it also tempts you to buy capital you may not really need and will not be able to obtain a good return on. When this happens, and especially if you use debt to buy unproductive capital while taking a tax deduction in 1 year, you will then need to make debt payments for that capital item from after-tax income in the following years. It can become a financial trap, so be careful. Try to understand marginal tax rates and how you might use tax credits or deductions like IRAs, health savings accounts, education credits, home interest, and so on. With that, I'd like to turn over the program to Leo for his insight from working with many farmers on tax advice.
Good evening. This is Leo Brooker. I have offices in Jefferson and West Des Moines. I'm a CPA and have been in the tax and accounting field for 34 to 35 years. I've worked in Kansas City and Des Moines before starting my own practice in Jefferson, and that's grown to now include, and as I mentioned, an office in West Des Moines. It struck me while I was working for others before I opened my own practice how specialized the tax field is for farmers. Our main clients in our practice are farmers, small business owners, and individuals, and we use many different types of entities that best suits the needs of our individual clients, that being corporations, partnerships, LLCs. What struck me as funny when I was working for others before I started my own practice is that I worked with large CPAs in large firms. CPAs in large firms. They weren't large. Anyway, and I saw them do tax returns of this control group of companies that I was the CPA for. And they totally didn't understand many different principles of the way different incomes were taxed for a particular farmer. When you're giving your records to your CPA or your accountant, it's important to break down if it was a breeding heifer that was sold versus a calf that was sold, because they're taxed totally different. And a breeding heifer that's sold is taxed totally different if it was raised versus if it was purchased. All these different questions can save you money on the tax return. It's interesting, in Iowa we have an exclusion for raised breeding stock that's sold. You completely get to take that off your state of Iowa tax return. Anyway, I wanted to mention that I'm married. My wife is Carrie. She's from Harlan, Iowa, and I see we have some individuals from Harlan, Ellen and Daniel. We have two daughters. Erin lives in West Des Moines, and Emily, our youngest daughter, lives in Omaha. So I just want to mention one other thing. It's amazing how our client base has grown over the years, using good service and dedication to good tax preparation as our main cornerstones. It's also amazing to me how technology allows you to keep in touch with your clients via web meetings. It feels like, even though you're meeting with a client in Colorado, it feels like you're sitting right next to them when you're on the web meeting, looking at them in the eye, in the camera. So I love the technology of the day. It lets us stay connected and do a better job for our farm and business clients. With that, I think probably Luke will want to turn it over for questions. Is that right, Luke?
First, let's have Jerry and Leo walk through your 2012 tax preparation plan.
Oh, okay. That's a good idea, Luke. Okay, let me get to that. Can you see the screen okay, Luke? Let's see here now.
I was thinking maybe first let's do some audio, just kind of tell a story about, like Jerry, what do you do to file your taxes every year with Leo, and then we'll go to that screen share. Is that okay with you, Leo?
Okay, this is Jerry again, and really the first thing that I do with Leo is, in addition to having Leo keep my books, I go to at least one pre-year end tax planning session. And so I have my books brought up to date. I know what my income has been. I know what my expenses have been for the year. I know how much capital I've purchased this year. And we feed that into a program that shows what my tax liability will be. And by doing that, I can say, well, you know, if I would pay for some more fertilizer, I could reduce my tax burden by this amount. Or maybe I'm not paying very much in tax, and I want to pay at least enough tax so that I'm at the top end of the 15% tax bracket. And so I may want to sell some additional grain before the end of the year. And I may want to, because it's kind of complicated, I may want to go ahead and make the adjustments that I think I want to make, and I may come back and spend another hour looking at at what we think is going to be my taxable income, and may want to make some additional changes at that point. After the year is over, we finish our accounting. We bring all the expenses up to date for the year, all the income up to date for the year. Of course, we have to account for, you know, any non-cash items, like if I sell a wagon, I want to account for that. Another non-tax or non-cash item is a lot of times the co-op pays dividends. They only pay you a portion of the dividend in cash, yet we have to pay 100%. We have to count that as income, 100% of that as income. And so we have all of those numbers ready. We have the 1099s that we received from other people. If you have a job, you might have a W-2 form that you want to make sure matches. We'll have 1099s from the federal government for the amount of tax or the amount of income that will be taxed on. And so we have all the information. We need to have all the information, and we'll then fill out the forms and file the income taxes. Of course, another thing that we have to do as business people is that we have to send out 1099s to people that we've paid a significant amount of money to, more than $600. And if we've hired anyone, we need to send them a W-2 form by the end of January. And I have found that most of the people that I deal with would like to have their 1099s and W-2 forms as soon as possible, because they're doing their own taxes and they have a filing deadline. So that's pretty much the process that I go through to file my tax return.
Luke, if I could just add a few thoughts. It's amazing, especially with farmers and their farm returns, how specific different credits and deductions have gotten. So it makes it a very worthwhile event to come in prior to the end of the tax year with many of our clients. I won't say that that's necessary with all the clients, and if it isn't necessary, we certainly tell them that, because we don't want them using resources that aren't necessary. But it's amazing with things like the earned income credit and the child tax credit, with how specific they are. You have to have your income between a certain level if you want to maximize those types of credits. So it's amazing the number of people that leave during tax planning and say, boy, this was a huge benefit, and they absolutely come back in November and December each and every year.
Wonderful. I do want to touch on the earned income tax credit. That's one of the things I'd like to have you expand upon before we end tonight. But I don't know if you wanted to go to your screen share first or not.
Yes, let's go to the screen. Let's go to the screen share first, because that will be we'll certainly get the earned income credit discussed at that particular time. Okay, I think that you can see, well,
Actually,
oh wait,
first
let me
click
see here.
Share My
Okay,
Screen, and then click the application,
that's right.
and then
Okay, let's
then
see if we
click the
can get it.
exact same.
Okay, now we'll get it going. Okay. Is that showing just fine, Luke? I think it should be showing to the audience in good fashion. Okay, good. What we have here is a farmer, a farmer and his wife by the name of Henry and Betty Farmer. I know it's not very original. And Henry and Betty have 3 children, and so they're going to file a joint return. And as you can see, we have 5 exemptions here. And Henry works off the farm, and he makes $50,000. Together, they received $250 of interest income and $200 of dividend income during 2011. And on their farm, they took in, I just did an example of someone beginning, maybe a beginning farmer or someone that didn't gross a lot, but it can be any numbers we want to put in here. But the sales for this particular farmer, Betty perhaps does some growing of some specialized crops during the year, and Henry certainly helps her when he gets home from work, and they grossed for that year $65,000. That particular year, if it was their beginning year or any subsequent year, they actually purchased a piece of equipment for $35,000 to help them in their planting and harvest. And for their normal expenses for the year, they had $38,000 for expenses. So they actually had a farm profit of $26,062. Now, the $35,000 capital expenditure for equipment was purchased in November, so it did not receive very much depreciation for the year. They make us use a midterm or mid-quarter convention rule that only netted $938 of depreciation. So our farm profit was $26,000. So the total income for the farm and Henry's W-2 and interest and dividends was $76,512. Now, Henry does not receive any benefits at his position, so they have to pay health insurance for their farm. And the health insurance that they had to pay was, how much was that? It was $10,200. So they had to pay $10,200, and that gets to be taken off their income on the front of the return. So they actually end up with adjusted gross income of $64,471. So if we just assume that they take a standard deduction and they get the personal exemptions for themselves and the kids, they have taxable income then of $34,371. So their regular tax is $4,306. They get $1,000 of child tax credit for each of the children since they're all 3 under the age of 17 at the end of 2011. So their net tax after the credits is $1,306, their net federal tax. Because they made a $26,000 profit on the farm, they have self-employment tax of $3,201. So total taxes on the federal return are $4,507. Henry had $5,000 withheld from his $50,000 salary, so they're actually getting a refund. Sure, go ahead.
Make sure you speak about 6 inches away from the microphone, because we're getting a little bit of feedback from the breath.
Okay. Okay. My apologies. The federal refund then is $493, and the state tax is $3,391. So they're actually Henry had $3,000 withheld from his W-2, so he actually has that as a credit on the, or as a deduction on the state return. So the state due is $391, so their net refunds for both the federal and state return is $102, as you can see right here. So if this if these folks would come into me in the summer and say, what do we need to do? A couple of things that we might, these are just simple little things that we might suggest. First question we might ask is, do the kids help on the farm that we have? And if they say yes, then what we might do is decide to pay them some wages. Okay, so we're going to just start a new case here and show what would happen if indeed we made some changes. So the wages that we would pay the kids, a child that's under the age of, or that is a minor that's being claimed by their parents, can make $5,800 without paying any tax. So maybe we might pay the oldest child $5,800, and maybe we'd pay the next child $5,400, and maybe the youngest child we would pay $4,400 if indeed they did that much work to help on the farm. And so those wages are paid to the children into their savings accounts. There is no payroll taxes on those. There's no Social Security taxes on those since they're your own children under the age of 18. The second thing we might do is we might implement a health benefit savings plan for the employee of the farm. And so depending on who's shown as the main farm owner, whether it be Betty or Henry, they might employ the other person for the work that they do and offer them a Section 105, Internal Revenue Code Section 105 health plan. And as we said before, the health insurance that they paid, I think, was around $10,200, and they had out-of-pocket costs of around $7,600. So that means that their total plan cost that now we get to take as a deduction on the farm is now $17,800. So now the expenses on the farm are $71,400 rather than $38,000. In addition to that, on the $35,000 piece of equipment that we bought, we might choose to write off as a Section 179 expense, which is a first-year write-off, $20,000 of that $35,000 piece, because it makes our farm profit then go to a loss of $27,000. And what it does is it makes our total income go down to $23,000, and it will virtually maximize several of the credits, like the earned income credit that Luke brought up just a little bit earlier. So now if we contrast this and look at the difference, whoops, I better, yeah, I did take that off. Okay, and notice that now all of a sudden we don't have any medical insurance being taken off this part of the return, since that's now being taken off in the farm business. So now instead of having $4,507 of federal tax, we have zero federal tax. And all of a sudden we have refundable credits of $8,415, and those are made up of two credits. The $3,000 of child tax credit now becomes almost all refundable. We're lacking $51 of it being the full $3,000 for the 3 children under the age of 17. And the earned income credit for that level of adjusted gross income and that level of earned income is $5,466. And that earned income credit is simply a gift from the IRS. It's nothing that you have to pay in. You simply get it back as a refund. So those credits go against any taxes due, and there's no tax due now. And the federal withholding that Henry paid on through his W-2 was $5,000, if you'll remember. So now, instead of getting $493 back on the federal return, we're getting $13,415 back on the federal return. On the state return, the state tax is now down to zero because we certainly reallocated some things, how we did some things. We paid into the kids' savings accounts, which they can use for college expenses, and we got to write all that off and save many, many taxes. As I mentioned before, there's many credits on states that are not taken, and I see many preparers forget to take several different things, and I guess some of those types of things are Iowa tuition, textbook and tuition credit for kids for their school expenses. You can actually take up to a $250 per child credit, or so it's actually up to $1,000 of expenses, and it's a 25% credit. So I'm assuming that for 3 children, we easily could have a credit of $322. And another credit that's widely missed is an early childhood credit, and that's for a small sector of children, but it's ages actually 3 through 6. And if you have a 3 through 6-year-old and you provide educational type expenses like reading books, papers, different types of things that help the child to be creative, or you take him to the science center, those things are all deductible, and actually, again, can go up to $1,000 of deduction for a 25% credit. So let's say that easily could be $180 in this case if they have a 3 through 6-year-old. So all of a sudden our credits on the state are now increased. So now we're getting $3,563 back from the state instead of paying $391. So our total refunds went to almost $17,000 instead of just a refund of $102. So by a few simple realignments on the farm schedule and also on the tax return, we increased our refunds about $17,000. Is there any further explanation, Luke, that you think I should give about this scenario? I know I went through it awfully fast, and I'd be glad to
let's
talk
ask the audience
individually about it.
No, that's great. That's a really interesting tool to show the scenario change. Let's check in with the audience real quick and see if anybody wants further explanation on any of those tax credits mentioned, earned income tax credit, and the childhood development tax credit, other things like that. At this point, it seems there are no questions on that specific proposal, but it really is a good tool illustrating what you can save with a CPA. What would it cost somebody to sit down with a CPA and run those kind of numbers? Kind of a money in, money out kind of thing.
Sure. Luke, I would say that for a year-end plan, if they are been a client of ours and we have their fixed asset schedule already in our system and they're done their tax return last year, typically we charge between $250 and $380 for a year-end plan like this. Ellen and Daniel are asking, how do you determine farm electric as an expense if it is all on one meter? That's a tough one. We typically look at several factors, and they're going to seem fairly obvious. If you have livestock on your farm, whether it be cattle, hogs, chickens, sheep, whatever it is, we take that into account, and we take into account how large the herd is. Also, certainly, if you have grain dryer bins on the farm, that certainly affects the percentage of deduction also. And it makes a difference what kind of year it is. This year, obviously, I think we were fairly dry and did not need a lot of drying. Jerry, I don't even think we needed any drying. Yeah, Jerry's shaking his head no, we didn't need any drying. So this year you may take a little less than some years. I guess, I mean, I have some huge operations where we take 90-some%. Now these folks do, I don't know, around $6 million of cattle and hog sales a year. And so they have huge operations. Sometimes we take 60%, sometimes we take 35%. But typically, it's somewhere in that neighborhood of 35 to 70%, I guess, is the best way to answer that, Ellen and Daniel. I know it's being very generalized. What other questions here? Are you able to hear okay? Is my feedback clearing up better?
Yeah, I can hear you well.
Okay, good. Amy's asking to describe a certain process. I'm not sure what process yet we're talking about. Amy is asking, describing how you work together doing the books. Typically, what we have done is ask the client, if it happens to be a farmer, if we can have a log-on screen or a view-only screen with their banking partner that allows us to go into their farm accounts and check different deposits and expenditures. Because sometimes when things go out or come in, especially if it's at the end of the year, we need to know exactly what's been spent. And this takes less time out of the farmer's busy day if we actually can log on to their site and get a copy of the last month's bank statement along with a copy of the checks and the deposit tickets. And it certainly works well when it is a person that takes good notes on their checks and deposit tickets. I always say for an IRS audit and for your record keeping, you almost can't write too many notes on a deposit ticket or a check memo area. So anyway, we interrelate in with those books with your banking partner and try to be as accurate as possible as far as what we're coding, so that we try to get to know your operation as best that we can. You know, do you typically sell raised breeding stock, or are those typically all purchased breeding stock when you sell them? Are you noting those on the deposit tickets and making sure and telling us when it's breeding versus the calves or just the feeders that you're selling? Or that's, you know, the example of the hogs and cattle. I hate to keep going back to that because I know we have folks doing many other exciting types of things.
This is Jerry back, and I think it's really important that you do a good job of describing on the check that you write what that item's for. And the same thing when you make a deposit, do a really good job of describing what the deposit is. You know, I don't allow tellers to make out my deposit tickets. I make out all my own deposit tickets because I want to be sure that I know, and I'm trying to make it even better. That it's more difficult to make it for Leo's employees to understand what the items are for. But after Leo's person enters my checks and enters my deposits for the month, I review them and make sure I think they've been coded correctly.
Another question that has come up here from Bossy Acres. I just love that name, Bossy Acres. Outside of asking other area farmers, is there an online source for finding CPAs in your own state that specialize in working with farmers? Obviously, you can go on to the state's, what of their online CPA here we have the Iowa Board of Accountancy that you can go online and see, find CPAs. But the specialized question here is, can you find CPAs that specialize in working with farmers? I don't know the answer to that right off, and perhaps Jerry does. We can go to him in a minute if he knows of any sources. A really good question from Bruce that I should speak to. This may show some lack of knowledge, but can you speak about donations in kind? Talking about a donation of a product, say a grain, maybe some bushels of grain, let's say, rather than cash. I think with the current times, I've heard of this happening more and more and more. I have a lot of clients that are giving so many bushels of corn to their church rather than cash. And I think the way that's typically handled by the farmer is he never tells the CPA about it, so it's just ignored on the tax return. I don't think that is correct, however. I think if it was to be done correctly, you would need to account for that grain as an income on your farm schedule and then as a donation on your itemized deduction schedule. And doing so would greatly reduce the benefit of giving items that way. Not that it's better or worse than giving cash, it's just not near as tax advantageous to treat it correctly as it is to just give it to the church and not tell the accountant about it. But I think in an audit you could have a particular problem. Okay, I'm reading down through different questions here. Oh, here Jerry's got a thought here.
You could, I think Amy Heath has asked about what you do with your receipts, and I keep and file my own receipts. You could probably negotiate with a bookkeeper to keep your receipts, but that's not what typically happens. Typically, I think a business would keep track of its own receipts and own invoices.
Thank you, Bruce, for your comments. I'm sorry I didn't mean to be so close to the microphone.
Daniel wants to know about filing for your separate enterprises, which you can't do.
Okay.
Ellen and Daniel are asking about whether or not you can file a separate tax return for each farm enterprise. And you can't do that unless you set up a corporation that own that enterprise. And I suppose some people do that in some ways, but for the most part, I don't think it'd be practical for most farmers to set up a corporation so they could file separately for each enterprise. What you can do, though, and what you need to do is be able to keep track of that enterprise from a profit standpoint. That's not a tax issue, that's a business analysis issue.
One question that we did not address up here earlier, I think it was possibly Amy that asked if all of the different receipts and records need to be handed over as well. We typically take a copy of those things. Actually, we scan those into a paperless file cabinet and then give them back to you, so that we try to be as green as possible. And it's also very handy for us to be able to go access those if we need those in for our tax audit in 1, 2, or 3 years. And a good point by Luke asking their local service who they recommended, and reputation referrals are huge. And I find that the farmers in our area are very good about networking and that's just something they do well, and they have a good, good society of people that work hard, and they talk at their different functions, and it works well. Here's a question from Bruce. Bruce is on some big issues here. Outlook on the 2013 estate tax. Do you think they will retain the current laws? That's an excellent, excellent question, Bruce. To bring everyone up to speed, what Bruce is alluding to is the estate tax laws are in a large state of flux right now. I guess that's one way of putting it. They have been allowing a deduction of $5 million. And again, I should preface this by saying I do not do any estate tax returns. I leave that to experts that deal in that field each and every day, and I am not one of those. But I did have the opportunity to go to a fabulous seminar this fall, and actually he gives one every fall in West Des Moines. And he addressed about estate tax issues, and actually the person that I was trying to think of his name, Christy Barton is his name, and he has a practice in Columbia, Missouri, and West Des Moines, Iowa. Practices in Missouri and Iowa. He's an attorney, and he does not do tax returns. He simply does a lot of estate work, and he's very, very, very knowledgeable about the estate tax laws. And what Christy said during that seminar, it was a one-day seminar, and I would encourage you to go. And he also has just a client seminar that he gives in the evening, like at 7 p.m. It's usually like the first or second week in November. But what Christy had said during that meeting is that what he's hearing from Congress in Washington is that they do not want to see any lower amounts than the $5 million on either side of the aisle, Democrats or Republicans. That was his contention. That's what he's hearing from his Washington contacts. The problem with those guys is they have been so bad about acting in a timely manner. They should have addressed this estate issue long before now and had a law in effect long before now, instead of putting us into this limbo stage. So it's a terrible situation that our Congress puts us in. They often do these things at last minute. But that's a really good question. And to my knowledge, from what Christy had said that day, he thinks there's no interest in lowering that from $5 million down, say, $2 million or $1 million again. So we'll see what happens. You never know.
There might be a little confusion about whether you keep track of the receipts when you're keeping books. You don't do that. No. Yeah, I think your answer is if you're keeping track of 1099s and tax information.
Oh, okay.
You mean, like if you're keeping my books, do you keep a copy of all my invoices?
Oh, no. Do you want to address or do you want me to?
Why don't you go ahead?
Let me clarify one point. Apparently I wasn't very clear about receipts and invoices when Amy had asked that, and Jerry has clarified something here. I don't keep a copy of every grain sale or every hardware store purchase or supply purchase of Jerry's when he brings in his books. I simply use his checks and or bank statements and or credit cards or whatever it might be, that debit cards, whatever it might be that paid for that, to insert that in the book. So I apologize if I was not clear on that.
Luke's asking about different ways you depreciate things.
Okay. Luke's asking about depreciation. Jerry mentioned the fact that the current tax laws are encouraging people to perhaps sometimes overspend with their operation. And you do see that in our business. There are different clients that will do anything to pay very little tax. And I guess probably Jerry and my feeling is that there's got to be a good balance there where you strike a good financial decision that indeed that if we're talking about a piece of equipment that it's needed in the operation, and probably you really need to do a little cost-benefit analysis of that piece of equipment to see if that's going to pay you to buy that, or whether perhaps it would be better to either do without it or rent it when needed. And none of us like to do that because it's not near as convenient and handy, and etc. But just as a side note, it's incredible this year the things that I saw happening in very small operations. I have one gentleman that all he farms is 500 acres, and these folks are buying brand new semi-tractors and brand new trailers to pull behind those semi-tractors for just a 500-acre farm. And it's incredible to me because 10 or 15 years ago you would have never seen anything like that. So it's really fun to sit in this chair and watch, see what's happening, and I'm excited for agriculture and the profits right now. Okay, Jerry, if you want to take a question, grab it from me here, or we can keep reading.
I'll comment on Luke's.
Here's Jerry.
Luke's asking about resources for bookkeeping and financial advice, and I don't know of any anymore. I've been doing the same thing really for so long that I haven't looked myself. There's the Iowa Farm Business Association that provides some services. Iowa State University Extension Specialists used to help point you in a direction. I think PFI is, in some of the Farminars coming up, might have some helpful information. But I don't think I can really answer Luke's question about good sources for accounting.
I like your comment here, Luke, about you feel like you spent the entire first year just learning things the hard way. And you're asking if there's a resource of recommending where to read, and I don't have an answer off the top of my head. I just don't. Sometimes you hate to say it, but sometimes maybe it's best to learn the hard way. Asking a lot of questions and talking to a lot of not only experts but other good farm operators in your area and other states too. Bossy Acres is asking how many farmers online here use QuickBooks. Kathy uses Quicken. One thing that I should mention, you need to be a little careful using a non-double entry system, because you can sometimes get things entered twice. So be careful using spreadsheets. I know Bruce had mentioned that a simple spreadsheet would work well. He's really right, but he's really correct. But I have also seen people, very intelligent people, that have missed perhaps getting a formula in a certain area, and they maybe miss a deduction that year of 10, 20, or 30,000. So I'd recommend staying with some type of an operation like QuickBooks, and make it double entry so that you're always balancing with the bank. And you need to remember to always balance out your notes too, because if you happen to make an entry against a note instead of a expense where it should be, then your income and expense are going to be off for the year. So always make sure that on your balance sheet for a QuickBooks type of operation that you're balancing your notes. It's good to balance them each and every month. We all know that's probably impractical because you guys get really busy in March and April, and you're probably not going to look at your books unless your wife or husband are really good about doing those when they come in. But typically you're going to be too busy to look at them until maybe June or July, and it's good for you to be dedicated to go back and balance all those things, the bank, the notes. Then if those things are balanced at the beginning of a period and the end of a period, beginning of a year, end of a year, then most likely the income and expenses on your income statement are going to be more than likely correct amounts. Luke's asking about filling out W-2 packets. It's interesting. I have a lot of clients that want to save the money for filling out 1099s and W-2s and the, what do you call that, the information sheets that go with those to go to the federal and state governments. And then seems like they call, and when they're doing that process, they call back to me 5 or 6 times asking different little questions about how to do different little things. So those things look fairly easy. Of course, I guess if you're going to ask me, I think you should have a professional do it. But certainly, if you get good at it, you can do it. It's kind of amazing though once you get in it, all the things there is to know about where to send things and how to do them. So anyway. I love Luke's comment here. I wish I would have done it every month instead of all 12 on December 29th. Well, at least you weren't doing it on the 31st, Luke, so that can happen. Like I said, the hard way, yeah. And George, I haven't seen too many comments from George. This is a good comment. Finding it best to enter everything into QuickBooks and enter the info onto a spreadsheet that I use for cash flow and taxes. That's kind of good when it kind of makes you go over the records twice and double checking them. So that's a good idea. Maybe Jerry is a unique combination of a farmer because he's so intelligent with the banking end of things. Maybe we should ask Jerry how he does his accrual, how he converts his records to accrual to find out if he's making money, each and every year. It's so important to have a good banker that can help you evaluate things, because I hear stories from a lot of bank officers when they are in a rural area and they go to their banking conventions, and they have some of the bankers that are in the larger cities saying, "You're loaning money on animals that could die." They just don't understand it. But I'll let Jerry talk about that one.
Well, I use the tax records, of course, to keep track of the taxes and my actual cash income and cash expenses. And so at the end of the year, and I used to do this monthly, and sometimes you should do it monthly, but I take an inventory and I know what I have for grain, livestock, feed, fertilizer, fuel. I don't really keep track of my parts, but I compare the statement that I have at the end of this year with the statement I had a year ago, and any adjustments I make in machinery value are based on what I really think depreciation is. And over the years, I've found that if you just devalue your equipment by 10% a year, that's pretty close to what depreciation will be, unless we have a huge spurt in inflation. And we can't count on that. We can't bank on inflation, so I don't do that. So at the end of the year, I depreciate my machinery equipment 10%. I have an accurate inventory of what I actually have on hand. I know what my note balances are. I know what my account balances are. I know that if I've purchased anything, I've accounted for that in the area of machinery. Now, if I've bought a piece of machinery, I'll add it to my machinery value. If I've sold a piece of machinery, I'll deduct it from my machinery value. And if I have any accounts payable, I have to enter that on my financial statement. If I have any accounts receivable, I enter that on my statement. And I bring up to date any of the loans I have. I not only know the principal balance, I know the interest balance that's due. And so I make all those adjustments to the statement. And I can compare how much money I had or how much net worth I had to a year ago. And as long as I don't increase the value of my farmland and I actually depreciate the value of my other capital assets, that tells me how much money that I actually earned over living expenses, because living expenses will have already been out of that. We can't deduct living expenses on our tax return, so tax income and tax expense doesn't reflect living expenses. So the net result that I look for every year is what I have as earned gain or earned income, and that's the difference in the value of net worth from a year before to today. And you can do that on a monthly basis. I used to do it when I used to raise a lot of pigs, especially feeder pigs, and my inventory would change monthly. I had a continuous production cycle, and I would, every month, I would make out an accrual financial statement and compare it with the previous month. And I got so I could pretty much predict which months I would make money and which months I probably wouldn't make very much money in because of production cycles and weather cycles. And so I'd still recommend that when you're starting out, is to try to keep track on a monthly basis how much money you actually made or lost that month. And it's interesting how that will affect how you manage your expenses, both your living expenses that are non-deductible and your farm expenses that are deductible. Because we can, when we manage and try, we can have an impact on our expenses. So that's pretty much how I would look at the accrual system.
Excellent, excellent verbiage hearing from a person that's good at banking and knowing how to keep control of your records. Kathy asks a very good question here, Kathy Dice. Don't you have to use, as Jerry was talking, she said, don't you? I think maybe perhaps there's some confusion when Jerry was saying he takes 10% off of his equipment every year. I think what Jerry's referring to, Kathy, is that you're certainly right. We have to use specific charts that take, like the first year, 7.29% off on a 7-year piece of equipment, which is the half-year convention, you know, all the different stuff. In the second year, it's 15% or whatever that is. I'm not sitting here looking at those tables. But you're right. You have to take, once it gets on a schedule, you have to keep with that same schedule on the tax return. But I think what Jerry's talking about here is it's very important to also keep a book tax, or I'm sorry, pardon me, let me rephrase that, a book depreciation schedule that's very fairly reflective of how that equipment is being depreciated and it's over its useful life and how much value is still really left with that piece of equipment. So I think that's what Jerry's trying to do, is rather than looking at those crazy depreciation numbers when you decide to write off, you know, a $250,000 four-wheel drive tractor, you know, he uses a schedule that keeps it real so he can keep his feet on the ground and know where he is financially, not according to the tax return. So I think that's some of the confusion there. So that was a good question, Kathy. Tim had asked what the threshold was for making quarterly tax payments. That's another really good question. Maybe many of you know, if you are a farmer, you are not required to make quarterly estimate tax payments, and to qualify for the definition of being a farmer, you need to have 66 2/3 of your income being made from farming. But the way they do that formula is skewed towards farmers totally. So if you do very much farming at all, you're probably going to meet that definition, because the way they do that is, like in our example of the example I showed you on the screen of Henry, he made $50,000 off farm, and then I think they grossed 65 or 75,000 on the farm. They don't use the net number from the farm. They use the gross income from the farm, like the grain and the livestock and etc., to calculate that 66 2/3 next to the W-2 income. So you do not have to use the net on the farm. So it doesn't take a lot to meet that 66 2/3 definition. And there's some rules about how many years you meet that, and etc. But that's a good question, Tim. So that's kind of the threshold. We are having more, it brings up a good point, we're having more and more farmers pay estimates to allow them to file, if they're a sole proprietorship and not a corporation, and because you haven't paid taxes all year long, haven't paid quarterly taxes, quarterly estimates, you're supposed to file and pay your tax return by March 1st, which obviously many of you know. You can delay that till April 15th if you indeed make an estimate of, I can't remember if it's 90% or 100% of your projected tax due by January 15th. Now you have to know what that projected tax due is, but anyway, if you make that by January 15th, you can wait and file as late as April 15th to file your return. So we have more and more farmers that are investing in things like ethanol plants, and so as we wait for those K1s from those ethanol plants, sometimes we cannot get the returns done by March 1st. So I find I'm having more people have to file those tax payment estimates by January 15th so they can wait to file in March. So that happens. Okay, moving along here. Grant likes Money Dance. I've not seen that, Grant, so that'll be good to go investigate that online. Dumb name, great software. I like that. Another thing I wanted to mention, as I was watching Bossy Acres typed about being a numbers geek and using QuickBooks, and he's exploring all the reports, and I think that's so important to your success is to have a numbers geek in the family and really get into the numbers and see what you need to do. One of the things I was going to mention is we have a lot of people, a lot of farmers that when they first get into doing records, they really don't want to pay us to do the entire records, but they'd like to be more hands-on doing it themselves, but they just are having a hard time getting the program set up on their computers. Well, now it's so great with web meetings because for very little money you can ask us to help or ask any of your people that use web meetings or are familiar with QuickBooks, which we use QuickBooks in this firm also, so are very familiar with it. We can go online and help you, and so really, even with our normal hourly rate, you can get a lot of help in 45 minutes for $80 and get a lot of questions answered of things that you just don't quite understand how to set up. So I'd encourage you to ask your advisor if they'll go online with you. That way they don't have to travel out to your house. It just works great. I love the technology. Okay. Sounds like Money Dance can be purchased for $40. That's a pretty good price. Jerry, did you read George's comment here about commenting about your discussion?
Sure, maybe. George is exactly right on what I was talking about. What's the value of my machinery and how much depreciation do I have in reality? Because if we write off a tractor we buy the first year, that means that from a tax standpoint it has zero value. But we know that's not true. When we buy a tractor or a piece of equipment, its useful life may be 7 years, it may be 10 years, it may be 25 years or longer. I use a tractor now yet that's 50 years old. And so what we try to do from an accrual standpoint, from a business analysis standpoint, not a tax standpoint, but from a business analysis standpoint, I want to know how much money I'm making. And so I have to allocate so much depreciation to my line of machinery. And that's where I came up with the 10%. That's really a shot from the hip. I mean, you could go through each piece and say, well, this piece is not going to last that long, or it's going to last longer. That would be a more accurate way to do it. But in my years of banking, we always looked at 10% of a farmer's line of machinery as being equivalent to depreciation. So if we had a farmer with a $200,000 line of machinery and he wanted to apply for another loan a year later, we would deduct 10% or $20,000 from his line of machinery, so we knew about how much collateral he had to pledge. And that worked out pretty well to tell us about how much money you're making. And the importance of that is that the actual amount of cash you're generating tells you about how much debt you can service. And so you need to know how much money you're making, and you need to know how much cash flow you're generating to service any debt you might have.
Excellent points, Jerry. There's so many good things coming across the screen, I don't know which ones to go through first. Luke asks a very good question. What are 3 things that beginners should do to make their farm's tax preparation easier, more accurate, less painful? what are the things that beginners need to know to help themselves with taxes? What part of this answer, Luke, you're not going to like, because it's one of these answers that's up in the air and nebulous and tough to nail down, because everyone's situation is so much different. Do you have children in the household, or do you have grown children that are in college? Do you have no children? Does your wife work outside the home? Not mean to be chauvinistic, because perhaps the husband works outside the home and the wife stays home and does the crops or the farm. But there's so many different things. So we're talking about some of the tools tonight that we use. One of the things I was going to mention, there was another thing written here. Make their farm's tax preparation easier, Luke. That's a good question. One of the things that could be done is print off, if you're just a sole proprietor, not just, but if you're a sole proprietor, get the farm schedule that's filled out on your tax return, the Schedule F, and categorize your expenses every year for the CPA into those categories that are listed on that form. And if you really want to make it so that your return has more accuracy, put them in the order that's on the Schedule F. One of the things that we do in our firm is we provide a client portal for each one of our clients. So we send out into that client portal everybody's individualized all their tax forms, and we also send out an individualized electronic organizer, which helps you organize all of your expenses, and it absolutely asks every question possible for you to get every deduction, every credit, anything that's possible, because we hit it with questions on that organizer. And that's a great tool because it's electronic. You can fill it out online, and you can take 3 days to fill it out or 3 weeks and work on it for 15 minutes and then save it and put it up and go back and finish it when you can. And when you do think you have it to the best of your abilities, you can just hit send and it comes right to us, and then we can visit either over the phone or in person about all the items that you put in there. And I think you'll have a very accurate return when you have a complete questionnaire like that. So I'm sure many of you have fabulous preparers that have those questionnaires that hit all the different subjects for you. So, really good questions here. Just excellent thing. Bossy also mentioned that they use QuickBooks for invoices as well, selling to restaurants, cafes, wholesale. I think QuickBooks does an excellent job with invoices. I have several clients that use them for invoicing. So, and Paul mentions here that actually QuickBooks 2012 Professional, $156. I have not looked at MoneyDance, and so I hate to go with what's familiar with you, but that seems like a good $156 to me. But I would get that over Quicken just for the advantages of it. I know. But Grant also says that he opens QuickBooks file type situation in MoneyDance, so, and gets free updates. So, and he's off his soapbox now. And Luke put in a link to the IRS Gov publications. Is that for the F, Luke? Yes, it is. 1040 F. Yep. That works really well to just get a good handle on how to categorize your expenses. So, and we can help you set those up in your QuickBooks. It's really easy to do. Very easy. One other quick comment: if you want to go online and look at how we do the client portals, my website is www.brookercpa.com. Currently, that's down for another few days for some servicing, but that'll be up pretty soon. So here, Jerry's got a comment about one other item.
Well, Luke asked about how to make tax preparation less painful, and really, if it's painful and you don't like to keep your own books, if you procrastinate and don't do it, and you just really don't like doing that type of work, you'd rather find something else to do, I really think it's well worth spending the money to hire someone to keep your books. Books aren't hard to keep, but if you don't do it, then you're running the risk of not being able to plan for taxes. You know you don't know where you're at financially throughout the year, and it's just way better off for everybody to have good records for taxes and good records for business analysis.
It's amazing to me to follow up on Jerry's comment. It's amazing to me. I have some farmers that are very intelligent businessmen, and they're just absolutely fabulous at record keeping. And they have us do their records for an array of reasons, but many of them are because they just simply don't take the time to do a good job with them, because they're busy doing the things that they need to do to make the farm successful. And I've had some people that are very successful farmers and very intelligent and very good at record keeping, make some critical mistakes and actually had to amend their returns 3 years in a row because of those mistakes. So it's kind of odd that you have those things happen, because record keeping certainly isn't rocket science, but it's just something you have to stay on. So Ellen and Daniel, I love your question. Is tax preparation deductible? That is such a good question. What we like to do in our firm is bill a very nominal amount for preparing the tax return, and then for all of our other work like the tax planning and looking over your records, we bill that for farm accounting. Certainly farm accounting is deductible. Tax prep is also deductible, but tax prep is deductible on your Schedule A. And I don't know if many of you know this, but typically Schedule A itemized deduction do not benefit the farmer very often. So even though tax prep is deductible on a Schedule A location, it rarely gets used. I know that's double talk. It's deductible, but you don't get to deduct it. I apologize for the double talk, but yeah, I guess you have to talk to the people that write the Internal Revenue Code, because I've often said people that write that do not use logic. So anyway, that's the answer to that tax prep deductible. So make sure your preparer or billing you correctly so that those items are deductible. These little things are important. As I tried to allude to earlier, it is not uncommon for us to take over a return that maybe a person that doesn't care as much, or just preparing the returns from the previous years, or maybe they just don't care about, they think that the credits are small. It's not unusual for us to get $500 of additional credits on the Iowa schedule for a person that's come to us as a new client, and it pays our fee. So they may seem small to them, a $100 credit here and a $200 credit here, but they add up to some real money. 8 minutes left, Luke says. Luke asks if there's specific tax credits to benefit startup businesses. There's some specific rules for startup businesses about what can be deducted and what has to be amortized over say a 5-year period. And I'd want to discuss those with you individually, but because they do get rather involved, but there's not very many specific tax credits. Recently, I've done a lot of work with wind generation and solar generation, and I'm sure many of you have looked into this, but there's just absolutely huge benefits depending on your operation. There's so many different grants and credits for wind generation that I have one client that is spending $335,000 on a wind generation unit for a 2 hog barn system. It's about, I think general population of hogs in those two buildings is around 5,200, 5,300 pigs, depending on their size. And so, as far as wind generation, those types of units are made to order for a wind generation unit. I mean, what I'm trying to say is the hog buildings are made to order for a wind generation unit because they need electricity each and every day fairly consistently. You know, month in and month out, spring, fall, winter, summer, they need electricity to run all the different elements of the barns. And basically, he's spending $330,000, and he's getting, he's able to, because of the tax benefits, he's able to sell grain of about $250,000 and not pay any tax on that grain. And in addition to that, he's going to be paying $300 less per month for his utilities than he was before actually paying the utility company. And that's right now, $300 less for his payment on the unit, on his wind generation unit. And that doesn't include well, not if, but how much utilities are going to increase electricity usage costs in the next 20 years. So it's incredible. It's just incredible, some of the numbers that you see, because the government gives a 30% tax break right off the bat that can be gotten as a grant rather than as a credit. Anyway, it's amazing. Is there anything else we need to talk about,
Yeah,
Luke?
let's just see if there's any more questions. And while we're waiting for one more, if there is one, I just wanted to thank you and Jerry for your time putting together a slideshow, Jerry, and also sharing your experience with that scenario to show the benefits of working with the CPA. That's pretty remarkable.
We really appreciate being here tonight. I've enjoyed watching Jerry's slideshow.
Our next Farminar is next week on January 17th. It's with 3 horticultural farms, 3 CSA market farms, and they're going to have their balance sheets, profit and loss sheets, and we're going to have a talk about profit and scale with different scales of vegetable farms. So you never know what's going to come up next on the Farminar series. It's always new stuff every week, and we try to catch everybody's interests throughout the series. And we thank you all for joining us. Please join us again next week. That's right, 7 o'clock Tuesday night, January 17th, for another Farminar.